take you inside that price action and outline what it is that I look for, what it is that I looked for at the time, and how I felt confident it was going to go lower. Okay. So right away, we know that price is traded up to the high end of that fair value gap. And again, this level here is that daily chart. Let me go back up one chart. That's this level here. Okay. It's on this candle, that low. And the low of the fair value gap is this candle's high. Dropping down into the hourly chart, that's the high end of the fair value gap. This is the low end of the fair value gap. Again, on an hourly chart. So that way we have our bearings. So when the market traded up into and just above that fair value gap high, this red level here, once it started to break down and go lower, it traded back down into this candlestick's high. So we're trading back inside this range, and we're range bound. Since I am expecting the daily chart to be the parent of this price structure, all minor lower time frame swings are going to be subordinate to it. And what does that mean? This now is a long-term high. I do not expect this high to be broken to the upside. Should it be broken to the upside, that means that my daily analysis, expecting this level here to hold price and to be a factor in the algorithm repricing and going lower at a later time, if it goes above that, then I'm probably wrong in my analysis. So therefore, I demand more information by studying more price action and sitting on my hands. Or if I have a trade on, it means that I have to admit that I'm wrong, and the stop out that may occur is just me managing risk. It's a losing transaction. It does not mean your model is flawed. It does not mean that you're a failed trader. It just means that that transaction was not a profitable one. And it's just a cost of doing business. But as long as price remains below this high, my idea is this is a long-term high because it's framed on what? A higher time frame resistance level, if we want to talk in terms of retail ideas. So that way we can understand something in a simplistic manner, but we'll build on the ideas that will help move you away from simple support resistance ideas. So this long-term high should remain intact. In other words, price should not go higher than that. We trade down to the discount level of the low end of that fair value gap. And it starts to find support, rallies back up, trades near the high, but does not take that out. Very important. Once it starts to break down and consolidate, in here, retail ideas will see a lot of trust in the idea that's potentially a bull flag. I love seeing those patterns because I like to fade them. So that's a false bull flag. And when we see price break down like this and then rally back up, every single time, and this is important, this is the part where you start writing down these details. Every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. I immediately label that in my mind, not on my chart, because I don't want anything distracting me. If I have these things written on my chart at the time, it's going to be a distraction to me. But the way I'm internalizing it, and you'll see what I mean as I go through this lecture, every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, that's an intermediate term low. What does that mean? What's the significance of that? Typically, what you'll see is an intermediate term low has a higher short-term low to the right of it and a higher short-term low to the left of it. This intermediate term low forms by rebalancing, but it has a higher short-term high here, but then the market trades over here off of this short-term low. It rallies up, but it fails. It fails in here. We're going to anticipate that failure. Whereas if you're looking at this low, high, higher low, failed, higher high, higher low. So what's forming here? A pennant or a triangle pattern, right? How do you know which side's going to break out? That was one of the questions I had all the time as a developing student back in the 90s. 1992, 1993, I was buying every book I could get my hands on. And I got the book, the John Murphy Technical Analysis of the Financial Markets book, which is the retail trader's Bible. Okay, that book is so useful in terms of just reading it and knowing what not to do, because that's what the 90% crowd follows when they look at price action. Still to this day, because it's always regurgitated in some way, shape, or form. Someone's teaching that same idea, uptrending trend lines, which are so subjective. How do you know what swing low to attach for a trend line? There's lots of swing lows in here. How do you draw it? It's all subjective. So you have to have a way to reduce it down to, I hate to say it like this, but it really is no better way of saying it, but you have to break it down into a science. We don't do technical analysis. We do technical science. Okay, you have to be able to relate to certain things, weigh out and measure what these factors are within price action, which is not based on hypothetical guesswork or some kind of a harmonic animal pattern, which to me makes no sense. You have to look at the relationship to price action and the relationship of how it behaves. What is it indicating? What is it showing? The market has traded higher and then consolidated. We failed to go above this important high back here. That's a long-term high. Then we have an intermediate term high. Why? Why is this an intermediate term high? Because we have a short-term high here and a short-term high here. So between two short-term highs, the highest high between those, that's an intermediate term high. But the main takeaway for your notes so far is anytime a imbalance, like this big candle up, is rebalanced, that becomes an intermediate term low. Just as well on the opposite end, this down move here, that's a fair value gap. As soon as it rebalances there, that's what I classify as an intermediate term high. Now here's where we take a huge step forward. Classically defined by Larry Williams, and you can see where I made a departure from his works. Okay, it was very influential in the beginning of my development, and it was a point of argument internally with me when I was watching him teach it on his VHS course, the Futures Millionaires Confidential Trading course. That idea of his approach to market structure, he teaches a little bit of it in this book. Okay, so it's Long-Term Secrets to Short-Term Trading by Larry Williams. There's not a lot of books. I have over 2,000 some books, and I can tell you literally there's a handful of books out of all my collection that are useful. And I can't bring myself to throw them away because, number one, I paid a lot of money for them, and it's just nostalgia. You know, me chasing all that stuff in books, and it's always the same stuff that never really works. The ideas that he teaches in this book here, they were taught in a early work by him in regards to market structure, how to internalize price structure, how to look at price not just from a higher high, higher low, because that's too myopic. Okay, it's a pursuit, especially in this generation today. It's a pursuit of simplicity for the sake of simplicity alone, not for the sake of getting to the truth or the heart of the matter. And that's what makes me a stumbling block for many of you that are younger, because you want right now instant gratification. You want instant reward for the menial time that you invest, when it's surprising to learn that you're going to take a lot more time than you first thought it was going to take to learn how to do this exceptionally well. But for an additional view on how I built this understanding in price action, it originally came from his idea of market structure. But if you study what I'm going to show you in this video lecture here, my paid group has never seen this before, and you're seeing it for the first time. Okay, so when you hear people talk about market structure and they're looking for a higher high, higher high, higher high, and having successive lower lows behind them, and then you have a failed higher high, and then it breaks the swing low right before that failed higher high, they look at that as a change in trend. Not all the time. Many times that's a good buying opportunity for me, because really that's just coming back down to a deep discount, and I'm going to buy those and continue it higher. So it's a little tricky if you don't understand the higher time frame, which is what those red levels are. That's higher time frame. The hierarchy in parent to child price swings, okay, so that way the subordination that the smaller time frame price swings adhere to from the higher time frame is directly linked to the order flow on those higher time frame charts. So in other words, what am I saying? The daily chart has the bulk of the volume that's coming into that marketplace. There isn't a lot of volume coming in on a 1 minute chart. That's not to change the importance or reduce the importance rather of a 1 minute chart within the proper context and market structure that's underway. So you can use a 1 minute chart to navigate, because as a smaller retail trader, which is who we all are, but we don't trade with retail logic. There's a separation from what we're trying to do in price versus the collective out there that learns from books and things like that. Now, that may sound like an oxymoron because I'm pointing to a book right here on the screen, but the ideas that he teaches early in this book about market structure, I think is the only thing I found useful in that book. I have a lot of respect for this man, but out of that entire book, his discussions about market structure, that's the only thing I find that is useful from that book. So if you're reading anything else in that book, great if you like it. But my only addition to this for more research, for more of a foundational idea where I got this from, you're going to hear people say, he teaches Larry Williams market structure. No, I don't. The ideas that came early on in my learning came from this man's interpretation of market structure. But I want to take you into the chart now and show you what he's not teaching in that book, what he hasn't taught in any of his works, and it gets a little bit closer to the heart of the matter, and you'll find that it's really interesting. So if we have a imbalance that's rebalanced and we have an intermediate term high, shouldn't an intermediate term high have a lower short-term high to the right of it and a lower short-term high to the left of it? Yes. Mr. Williams says so in his book also. What I discovered in my own study, no one taught this to me, okay? I kind of pioneered this idea. See a lot of these Instagram guys out there saying they pioneered something in the last 2 years of trading. The idea of a intermediate term high not being higher than the short-term high to the left of it or the short-term high to the right of it. In other words, it's going lower. An ideal scenario should be this high should be above both short-term highs. But it's not. It's not. So what is it doing? It's only rebalancing this. And where is it likely to go? Well, if you're thinking in terms of a pennant or a triangle pattern, it's indicating to me, as soon as this candle starts to go up like this candle and this candle. Why not this candle too? Well, this candle only has this low here. This candle is an up close, but this starts the last two up close candles right before this move down. This is important because we're going to look inside this shaded area and how we can use highly precise ideas within this order block. I'm anticipating this run up with these candles forming an order block where everyone else is teaching the idea of the last up close candle before the down move. That is not my order block. That is not my order block. So you need to stop teaching that because it's not accurate. Call it something else, but don't call it order block. This movement here, these two green candles that are going up, I'm watching these as they form live with the expectation, because this imbalance has been rebalanced here, this swing high is an intermediate term high. I do not expect this high to be taken out. So I'm already forecasting and anticipating a failed price swing in here. Every time this green candles are forming, I'm looking at that as a bearish order block. So from the beginning at that candle's low, I'm looking in time on lower time frame charts. Lower than what? Well, this is a 1 hour chart. So what's the time frame below that? I dropped to a 15-minute time frame. Now, before I get any further, just know that the range between this long-term high and this long-term low, that range is going to be used for targeting purposes, and I'll get into that in a moment. But these up-close candles, from the hourly perspective, that's the range for my hourly order block. Inside that range, I can be hunting fair value gaps. Light bulb. I don't need to see the market trade down below the last highest up close candle. I don't need that, because I understand what I'm looking for inside market structure, actual market structure, not just higher high, higher low. I'm looking at the underpinnings of the marketplace, and I'm examining what is it doing high to high, low to low, within a higher time frame premise. Remember, the premise was we were going to go up to this upper level here, rebalance, and then eventually trade lower down below sell side liquidity. In this fractal, I'm using this one here just to illustrate the idea. So in other words, up here, it's going to make a short pattern, something bearish to get short on. Then work towards going down to that low. Now clearly you can see it here. It does so nicely. But I'm going to take you into this price action right here. Before I zoom in, look closely. What do you see? Pause the video. I'm not pausing the video, ICT. And you can't make me. All right. Right in here, you can see a small little imbalance. This one single candle like that, right there. That's the same thing that was occurring in this move here on the hourly chart that gets rebalanced there. Here, we have a smaller version of it. That is a fractal. That's something that repeats on a smaller or higher time frame that's similar in its formation. It won't be identical, but it's closely related to the general idea. If it trades back to this candle's high, don't worry, I'll zoom in a moment. That's your entry right there. That's aggressive, and I don't have a problem being aggressive if I know what I'm looking for. But there's also an imbalance in here, and it rebalances that right there. See that? Now, once we establish the market structure on that hourly chart, I'm not going down into the lower time frames below it and marking out all the swing highs and swing lows either. That's overkill. I just need to know what I'm looking for on the time frame I'm trading on. The logic is based on that daily chart that it's going up into this imbalance to go lower. The hourly chart frames my trade. It gives me what I'm looking for to start hunting entry techniques. Now, the 15-minute time frame, that's the bellwether. This is where it's going to give me the actual get in, get out. But I might not like the risk parameters that's required on this time frame, so I can go down into lower time frames. Should price go lower and break lower, I'm looking at that short-term low here and that in-range-term low there. If we have a short-term low taken out and an intermediate-term low taken out, or just an intermediate-term low taken out, then we can go back to the previous long-term high, long-term low. Now, a long-term high and long-term low is generally going to be linked to a higher time frame daily chart. That might be a price range. It might be a high to a short-term low. In this case, I'm framing the idea and logic around that fair value gap that I outlined in front of all of you, saying it's likely to go up there, rebalance, and then go lower and take out that old daily low. There's lots of ways you can frame your trade, but you have to have something directly linked to that daily chart, because the daily chart, that's exactly what institutions are working off of. That's exactly what banks are working off of. That's where the money is. That's where your bias is going to be determined. That's going to be what makes or breaks your trend continuation, that daily chart. So the majority of your time and study should be on determining where that daily chart's going over the next day or two or a week. But you try not to forecast longer than a week. Not that you can't. I'm not suggesting that anyone can't do that. I'm just saying if, as a developing student, you want to keep your perspective limited to a 5-day time horizon. And don't be upset if you don't have the entire weekly range forecasted correctly. That's not important right now. You're growing. You're trying to learn how to do this, and it's highly technical. No one gets it overnight. It took me 6 years. But it pays off if you stick with it. So if we have a break below an in-return low, then we have what? A significant break in market structure. This is something that's more significant just simply than going into a chart saying, okay, well, it took out a short-term low, there it is. See how much more detailed this is? What this tells me is, then I can start using this range, high and low, and start getting projections down. I can get a measurement of measuring this high to this low and start replicating that going down. And it'll give me price targets. They're generic price targets. If you don't want to use that targeting method, this long-term low to intermediate-term high, if price breaks below here, as it does here, you can simply take your Fibonacci, anchor it to the highest high, down to the lowest low, and this is what you would get here. Why am I using that? Why am I not using this here to here? Because this return back up, this is where all of this move starts right there. This is just the beginning of the framework. This is where the swing begins on the decline. Follow what I'm saying? I'll say it again. This high and this low, that's your framework. The retracement that fails, that starts the decline, begins here at the intermediate term high. So if you anchor your fib to the intermediate term high down to that low, which is a long-term low, the projection is negative 1.5 standard deviation, and there's your low. How much lower than this can it go? That's one way of determining it. Now I know what you're asking. What is your fib settings, ICT? There's my fib settings. Okay. I don't talk